Welcome back to the Wall Street Podcast.
Today, we're diving deep into some key reports from the Wall Street Journal, specifically the Friday, July 2025 edition. Our aim, really, is to unpack the big economic shifts, corporate moves, and policy impacts shaping the market right now.
Right. Let's kick things off with trade policy. It feels like that's having some very real-world impacts already.
Absolutely. The journal reports the U.S. brought in an extra $55 billion in tariffs this year. But interestingly, big U.S. companies, like GM and Nike, they've largely absorbed these costs.
Absorb them, so not passing them straight to consumers.
Not immediately, no. It seems like a strategic choice to keep their market share, even if it hits their margin short term and internationally. Well, the European Central Bank has actually paused interest rate cuts. They're citing uncertainty over these U.S. tariffs directly.
Okay, so it's having global ripple effects.
Definitely. You see high-level responses, too. Bernard Arnault at LVMH, he's actively lobbying EU leaders for a trade deal. He's even planning a new Louis Vuitton factory in Texas. That's quite a strategic hedge against potential tariffs, isn't it?
That's a fascinating strategic play, a real global chess match. Okay, shifting gears now, let's talk tech. Some huge shifts happening there.
Indeed. Take Intel. They're going through a pretty dramatic restructuring. We're talking about 15% workforce layoffs and scrapping plans for new chip plants in Europe.
Wow, that sounds like a major pivot.
It is. It's an aggressive move towards the AI chip market. Shows you the stakes involved in that space right now. And you have Tesla with Elon Musk. He's trying to shift investor focus, talking of future revenue from robotaxis, humanoid robots like Optimus.
Yeah.
This general-purpose robot idea.
Even though their current numbers aren't great.
Exactly. Automotive revenue fell 16%. Market share dropped over 8%. So it's real contrast, a long-term gamble on future tech.
It's certainly a bold vision, but Google seems to offer a different story on AI's impact right now, doesn't it?
Precisely. Google's core business, search advertising. Revenue is up 12%. And they say AI overviews are boosting ad impressions by almost 50%. That's immediate impact.
So AI is enhancing their current model, not just a future promise.
Right. And as a result, they've actually raised their 2025 capital spending forecast to $85 billion. Huge investment, but driven by current results. So you see these two paths, Tesla betting on brand new future streams, Google using AI to turbocharge what already works.
That's a really key distinction. Okay, let's dig a bit deeper into those absorbed tariff costs you mentioned. If businesses are eating these costs now, what are the implications? I mean, are consumer prices just going to jump later?
Well, the journal suggests that's a real possibility, yes. Potential for delayed price increases. Inflation on those goods is mild for now, but companies likely won't absorb costs forever. They might raise prices once policies stabilize, or maybe if competitive pressures let up.
So it really highlights how competitive things are right now.
Exactly. It's stopping that immediate pass-through. But consumers could feel it down the line. It's sort of a waiting game.
Okay. And turning back to Tesla, Musk's vision of stratospheric value from robotaxis and Optimus, how realistic is that really against their current financials? Is it, maybe a distraction?
It's definitely high risk, high reward. That 16% drop in auto revenue is a stark contrast to this future vision, which, let's be clear, generates no disclosed revenue today.
Right, and competitors exist?
Competitors like Waymo are arguably further along with actual robotaxi services already on the road. And Tesla's strategy, it needs more than just tech breakthroughs. It needs huge regulatory hurdles to be cleared for autonomous driving, for robots, plus market acceptance. So that stratospheric value, well, it hinges entirely on a future that's still quite uncertain and faces big external challenges.
Understood. Okay, finally, there's this interesting point in the journal about global economic resilience despite all this uncertainty. What's actually propping things up, and what are the weak spots we should watch?
Yeah, it's a bit of a mixed picture. The resilience seems to come mainly from things like falling U.S. jobless claims, strong service sector activity that points to healthy domestic demand. Plus, we're seeing some unexpected strength in Europe and Asia, too.
But there must be vulnerabilities.
Oh, definitely. The clear vulnerability is in manufacturing, it's contracting. That seems partly due to the tariff front-running effect, wearing off, companies buying ahead of tariffs, and also just ongoing worries about trade policy.
So an unbalanced picture, then.
Exactly. It suggests an unbalanced recovery. Services are holding up, but manufacturing looks fragile. Trade policy remains a really significant wild card for overall stability.
So wrapping this up, what's the big takeaway? It feels like markets are juggling some really complex forces here: trade, tech transformation.
I think the key is recognizing how interconnected all this is. You need to consider how these dynamics tariffs, influencing corporate strategy, tech bets, shaping future value, will mold the investment landscape and company decisions in the coming months, maybe even years.
It demands a very nuanced view of risk and opportunity. Thank you for tuning in to this deep dive.